This is a lecture from OpenTuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
This video is going to go through now and crunch the numbers. We're actually going to go through and perform the impairment review so as to see whether or not that asset that is within our financial statements has actually fallen in value. Okay, so you've got the notes up there. So what we're going to go through and do is just summarize how to crunch those numbers, because what we need to go through and do is we need to look at the carrying value. So the carrying value is that figure that you see within the statement of financial position. So for you and I, that item of property, plant and equipment, that intangible, or potentially a business, but leave the business for the time being. We're just going to focus on individual assets to start off with. So what we've got there is that if the carrying value is greater than the recoverable amount, then the asset is impaired. Okay, so the recoverable amount is effectively the amount that we would expect to get, being the better of whether or not we were to sell it or to continue using it. How much benefit would we get from selling it or using it? So that recoverable amount by definition is therefore the higher of the value in use. So if we carried on using the asset and generating those cash flows, or alternatively, the fair value less cost to sell. Okay, so if we were to decide upon selling it, we would realize the fair value but incur those selling costs as well. So we would go through there and look at the higher of, because we're going to think of it logically. You know, if you had the choice of selling it or continuing using it, you would go with the one that brought you the most benefit, isn't it? So the recoverable amount is the higher of the two. Once you've got that recoverable amount, if the carrying value is greater than that recoverable amount, then the asset is impaired. We will reduce the carrying value down to that recoverable amount, and then we will depreciate that asset over its remaining useful life. Okay, just bits and pieces to add in. I think we've spoken already there, haven't we, about what the recoverable amount is. Fair value less cost to sell, we know what that is there. Just note value in use, you're not going to have to do any serious discounting here in this exam, but that's the present value of the future cash flows from using the asset. Okay, there's a lot more detail behind that within the standard, but at this level, that's effectively all that we are required to do. Okay, if you want to get into the detail, it starts looking at the specific cash flows to include, how long we should go through there and consider those cash flows for. It talks about the discount rates that you need to use. No thanks, this is financial reporting. Save that for SBR, strategic business reporting. We just want to be able to compare the carrying value to the recoverable amount. For the value in use, we will be given the cash flow and we will be given the discount factor. So cash flow multiplied by a discount factor gives you the present value. Okay, fair enough, isn't it? So let's put that into practice with this little example. So what we've got here is it wants us to prepare the extract from the financial statement. So once again, statement of financial position, statement of profit or loss. The year ended is December 20x9. And then we've got a little bit of background information, haven't we? Okay. We're told that the machine was acquired on the 1st of Jan X5. X5, all of X5, 6, 7, 8, 9. So that's 5 years ago. It cost us 50,000 and has a life of 10 years. So we will be able to depreciate that asset down to its carrying value when this impairment review takes place. When does that impairment review take place? It's there at the 31st of December, and that coincides with the reporting date, doesn't it? So we have performed the impairment at the end of the year, okay? Presumably because there was some form of impairment indicator, okay? We're told the fair value of the machine is 26,000. Cost to sell are 2,000, so we will use that to calculate our fair value less cost to sell. Cash flows are $5,000 for the next 5 years, 10% discount rate, and our annuity factor is there at 3.791. So we can apply that annuity factor to the cash flow for 5 years to work out the present value. Okay. Everybody happy with that there? No, not yet. Yeah, let's go through and have a play around with it. So what have we got? It wants us to look at the extract from the statement of financial position. It wants us to look also at the statement of profit or loss. There's no revaluation, so there's not going to be any OCI. Okay. What we need to look at will be this non-current asset that we have. So the property, plant and equipment. That asset will be depreciated during the year, and then there may be also an impairment. Okay. So let's go through that, put in a small working to work out the bits and pieces. So what we've got there is, let's look at it in columnar formats. So we bought the asset, was it there on the 1st of the 1st X1? Was it the 4 careful, make sure I get 1st of January X5? I had my page the wrong way round. I was looking at the next example. Careful, Christopher. A cost of 50,000. And then the review was performed on the 31st of December X9. So we need to work out that carrying value, don't we? Okay. Well, we need to look at the accumulated depreciation. So 50,000, was it over 10 years? And this asset will have been depreciated for 5 years from the start of X5 to the end of X9. So the accumulated depreciation is 25,000. Just note, of that depreciation, 5,000 will have been charged this year. Okay, in terms of marks, you've got an asset, forget the impairment, it's depreciated. Okay, the depreciation charge for the year is simply 5,000. Okay, that goes through there and gives me a carrying value of 25,000. So what we're now going to do is we're now going to compare that to the recoverable amounts. Okay. The recoverable amount, remember, is the higher of the value in use and the fair value less cost to sell. Okay. Easier marks will be to work out the fair value less cost to sell. Fair value is 26. Cost to sell are 2. So that gives you there, is it, the 24,000. Okay. The value in use, that's a little bit more of a challenge. So what we've got here for your value in use is that your cash flows are 5,000 for 5 years, and the annuity factor is 3.791. If I tap that onto my calculator, and I'm sure you will all correct me if I'm wrong, is 18,995. Okay. The higher of the two is the fair value less cost to sell. Is now that carrying value greater than the recoverable amount? Well, if the recoverable amount is 24,000 and the carrying value is 25, then yes, there is an impairment, isn't there? That impairment needs to take the asset down from the 25 to the 24, which gives me 1,000. Okay. So what we have now is that 1,000 is the impairment in the statement of profit or loss. And the 24,000 is now the value in the statement of financial position. So what we've got now, if we go back to our pro forma, PPE is 24,000. The impairment is there as 1,000. Okay, there we go. That's it. Multiple choice questions could ask you to work out the carrying value after the impairments. They could ask you to go through and work out the impairment itself. So there's plenty of options there for the examiner to go through and try and trip you up. Other little point just to note, I suppose, what is the subsequent treatment now of this 24,000 carrying value? Well, not part of this actual question, but just something to note. That 24 is now depreciated over the remaining useful life. Okay, which in this instance, I think is 5 years. Okay, we bought it in Jan X5. The impairment took place on December X9. That's 5 years. 10 years in total. 5 years have gone, so there's 5 years left. Okay, there you have it. So if you're there in terms of section C question, that's what you're looking at. If it's A or B, it's asking you to calculate any one of those numbers as part of that multiple choice question. There we go. What we'll do within the next videos is we'll go and start looking at how to record that impairment, whether or not it is a specific asset that is being impaired like we have here, or whether or not we are impairing a cash generating unit. Cash generating unit? What's that about? We'll see shortly. See you in a bit.